Hi, welcome to another episode of My Home, My Sale on Homeowners Corner. Today we're going to be discussing home equity, a comprehensive guide to cash out refinances. In the landscape of home ownership, the concept of cash out refinancing stands as a powerful financial tool, allowing homeowners to leverage their property's equity for various purposes. This article aims to serve as a reference guide, educating homeowners on the nuances of a cash out refinance, including loan to value ratios, credit score requirements, and the essential aspects of the underwriting process. Understanding cash out refinancing. What is a cash out refinance? A cash out refinance involves replacing an existing mortgage with a new one, where the homeowner borrows more than the outstanding balance and receives the excess funds in cash. Common uses of cash out refinances. Homeowners often opt for cash out refinances to fund home improvements, consolidate high interest rate debt, cover educational expenses, or invest in other properties. Loan to value ratios for various loan types. Fannie Mae loans. Fannie Mae typically allows a maximum loan to value ratio of 80% for cash out refinances. This means homeowners can borrow up to 80% of their home's appraised value. Freddie Mac loans. Freddie Mac follows similar guidelines, permitting a loan to value ratio of up to 80% for a cash out refinance. Fannie Mae and Freddie Mac are basically a conventional home loan. These are just different players in the secondary market that lenders look for underwriting guidelines. FHA loan. FHA loans offer flexibility with the loan to value ratio of up to 85% for cash out refinances. However, specific requirements may vary based on individual circumstances. VA loans. VA loans available to eligible veterans often provide the most favorable terms, allowing for a loan to value ratio up to 100% of the home's value. This means qualified veterans can potentially borrow the full appraised value of their home, but keep in mind, most lenders will often cap this loan to value at 90% in most cases. This limit also includes the VA funding fee if applicable. Credit score requirements. When I talk about Fannie Mae and Freddie Mac, this is for a conventional home loan. Fannie Mae and Freddie Mac generally have a credit score requirement of 620 or higher is recommended for a cash out refinances. However, a higher credit score may improve interest rate terms. Consequently, a lower credit score will make your interest rate a little bit higher. FHA loans. FHA loans are more lenient with the minimum credit score requirements typically around 580. However, most lenders have their own criteria, and for a cash out refinance, most lenders are going to require a credit score at least in the mid 600 range. VA loans. VA loans often have flexible credit score requirements, and veterans with lower credit scores may still qualify. The underwriting process and qualification. Credit, income, assets. Homeowners pursuing a cash out refinance must undergo the underwriting process. This involves providing documentation of credit history, income verification, and details about assets. Appraised value. This is going to be the most important aspect of a cash out refinance because the amount of cash you're going to receive is going to be based on the appraised value. The amount a homeowner can cash out is determined by the appraised value, and the loan to value is going to play a crucial role in the calculation. Debt to income ratio. This is a new loan, so lenders are going to assess the borrower's debt to income ratio to ensure they can manage the increased mortgage amount. Guidelines may vary based on different loan types. Considerations for homeowners. When it comes to a Fannie Mae or Freddie Mac conventional cash out refinance loan, loan level price adjustments are factors that influence the interest rate and pricing adjustments applied to the loan. These adjustments are determined based on specific risk factors associated with the borrower's creditworthiness and the characteristics of the loan. In this article, I have included what the loan level price adjustments are. Please be sure to check out our website for the complete loan level price adjustments. What it basically means is there's going to be your interest rate is going to be determined based on what your loan to value is and what your credit score is. Obviously, the lower the loan to value, the higher credit score, you're going to get the most favorable loan terms. But if you even have a 720 credit score and still trying to get an 80% cash out loan, some lenders still may consider that a higher risk because of the cash out. So you may be hit with an interest rate price adjustment. Please consult with your mortgage loan officer about your specific mortgage terms. Credit score. Fannie Mae and Freddie Mac considers the borrower's credit score as a key factor in determining the loan level price adjustments. Generally, a higher credit score is associated with lower risk, while a lower credit score may result in higher pricing adjustments. For example, borrowers with excellent credit scores may qualify for more favorable terms. Loan to value ratio. The loan to value ratio, which represents the amount of the loan compared to the appraised value of the property, is another critical factor for loan level price adjustments. Fannie Mae, or on conventional loans, typically applies loan level price adjustments based on different loan to value bands. A lower loan to value ratio is generally associated with lower risk, while higher loan to value ratios may result in higher pricing adjustments. The combined impact of a borrower's credit score and loan to value ratio determines the total pricing adjustment applied to the interest rate for the cash out refinance. So this is going to be very important to take a look at. Obviously, you may see what a conventional 30-year fixed rate is, and that rate is available maybe on a typical refinance. But if you're doing a cash out refinance up to 80% of your home's value, and even if you have a 780 or 800 credit score, there still may be some loan level pricing adjustments applied to your interest rate. Homeowners should be aware of the limits imposed by their chosen loan program to determine the amount of cash that they can assess based on the property's equity. Long-term financial impact. While cash-out refinances offer financial flexibility, homeowners should consider the long-term impact on their mortgage and overall financial health. Seeking advice from mortgage professionals, such as a loan officer or financial advisors, can provide tailored insights based on your individual circumstances. A cash-out refinance is a valuable financial tool, but homeowners should approach it with a comprehensive understanding of their equity, loan-to-value ratios, and the individual qualification criteria. By being well-informed, homeowners can leverage the benefits of a cash-out refinance to meet their financial goals responsibly. This has been another episode of My Home, My Sale. Thank you so much.